Hi, I'm Shawn Bragdon with BGA Insurance, and today I just wanted to give you a brief education on Index Universal Life. There's quite a few slides in this presentation, but I'm just going to go over the main topics and the main slides that I think will get most people a good understanding of how an Index Universal Life product works. Right now you have a chart that let's just assume that you had $100,000 in a traditional equity account. Let's just call it an S&P 500 mutual fund. So the market goes up 10%, you're at 110,000. In year two, the market drops 15%, so you're at 93,500. And then year three, the market rebounds up 5%, so you end up with 98,000 and some change. That's a typical equity investment, something that you can lose principal in. By contrast, if you put the same $100,000 into what's called an index universal life product, the market goes up 10%, you're at 110,000, but your gain is locked in. You're never going to lose your gain because when the market drops in year two, you do not go down with it. You're contractually guaranteed to get a zero when the market drops, and you're going to start at your ending point in year three, in this example, up 5%, and you end up with 115.5, which is a 17.6 improvement over a traditional equity investment. I really like this slide. This slide shows the growth of $100,000 from January of 2000 to December of 2023. In red, we have the S&P 500. You might recall, starting in 2000, we started off with a 3-year bear market. The market went back up. In 2008, we had another bear market. It went back up. And then in 2022, we had another bear market. So over this 23-year time frame in the S&P 500, your 100,000 grew to 324,000. By contrast, if you put the same $100,000 into an index universal life product with a 12% cap and a zero floor, and what that means in English, your return is always between 0 and 12%, depending on what the S&P 500 does. You got some zeros out of the gate, some 12s along the way. Over this 23-year time frame, your 100,000 grew to 493,000, which is a vast improvement over the S&P 500. Even though the S&P 500 actually averaged a greater rate of return over these 23 years, you actually have more money in your index UL account because you've eliminated those losses. Another thing I really like about an index universal life product is the fact that you can capture significant gains even in a very bad market. So the 1930s depression was the worst 10-year period of the S&P 500. If you had $1 million in the S&P 500 in 1930, over that entire decade, you made no money. But if you had $1 million in the S&P 500 with a 12% cap and a zero floor, you made almost $600,000 in the worst 10-year period of the market. And the reason for this, and this is part of the secret sauce of the index UL product, is they have what's known as an annual reset. So you buy into the product when the S&P 500 is at 6,000. Over the next 12 months, it drops to 3,000. It resets, and then you go from 3,000 back to 6,000, where a typical equity investment, you'd be at break even. You were able to capture all those gains going from 3,000 to 6,000. So that's a very attractive element of the index UL product. You've probably seen something like this before. If you're talking about a traditional equity investment, something you can lose principal in, if the market drops 30%, you have to make a 43% return the following year just to be at break even. This is an interesting question you might pose to some of your clients. Do you know the difference between an average return versus an actual return? So let's say I'm your money manager. You give me $100,000 in year one, and I hit the cover off the ball, 100% return. Year two, I don't do so well, 50% loss. So your 200,000 goes back to 100,000. Year three, another rebound year, 100% return. So you're back up to 200,000. And then year four, another 50% loss. So over this 4-year period, you started with 100,000. You ended with 100,000. You made no money, But as your money manager, I'm advertising the fact I've averaged my clients a 25% rate of return over the last 4 years. With a traditional equity investment, average returns can be very misleading because you have the potential of loss. Where with an index universal life product, it's an actual return because we're eliminating all your losses. This is what I would call my elevator pitch for an index universal life product. Would you be interested in a retirement product that is a historical rate of return north of 7%? You're guaranteed to never have a negative rate of return. The money grows tax-free. You can access the money tax-free at any time, and it's completely liquid. And what I mean by completely liquid, you put in at $30,000 today, you change your mind and want all your money back tomorrow, next week, or next year, you can get it. Do you have any of that in your portfolio? What I just described to you is an index universal life product with an early cash value rider that completely eliminates the surrender charge and makes it liquid from day one. This is actually our most attractive report that we can add to any index universal life illustration that we send out from BGA Insurance. It compares an index universal life product to a taxable account. That's going to be a brokerage account, a taxable mutual fund, a tax deferred account. That's going to be more specifically a variable annuity, and TDRP, that stands for tax deductible retirement plan. That's a hypothetical 401k plan that allows you to contribute money pre-tax. So this report takes real world taxes and management fees into account. So we have a 45-year-old guy that's putting in $30,000 a year for 20 years into each one of these retirement vehicles. We're assuming a 6.38% rate of return on all these retirement plans. You'll see our taxable accounts here, our tax deferred account here, our tax deductible retirement plan or 401k plan is right here. And over here we have our index universal life product with that early cash value rider that I mentioned. You put in $30,000, your cash surrender value is $30,000 year one. And then here is our death benefit over here. We're solved for the minimum death benefit possible without violating the insurance regulations so that we can minimize the fees and charges and maximize the cash value in the policy. So what you'll see is all these traditional retirement accounts start running out of money. So right here we have our our variable annuity actually runs out of money at age 73, and the reason for that, it had the highest amount of fees in it. Our brokerage account or mutual fund taxable account runs out of money at age 74. We're still doing okay on our 401k plan, but let's go to the next page. And you see our hypothetical 401k plan runs out of money at age 76. Yet we're still chugging away with $110,576 of tax-free retirement income coming out of our life insurance policy. And if you make it to age 99, you still have $1.2 million in cash value and death benefit on your index universal life product. We end up pulling out over $3.8 million tax-free out of our index universal life policy. Our next best option was our hypothetical 401k plan, assuming you had the ability of contributing that much into a 401k plan, which most people do not have that option. And then you have our variable annuity and our mutual fund or brokerage account over here. So they all come up short. We're pulling out substantially more money out of the index universal life product, and we're taking on less risk because all these other products, are in essence equity-based products where you have the risk of principal loss. Where index UL, if the market tanks, you're guaranteed to get a zero. I really like this page of this report. This shows you the rates of return you have to achieve on these traditional retirement accounts to compete with an index UL growing at 6.38%. Is your brokerage account or your taxable mutual fund, are you getting north of 11%? Most likely you're not. Is your variable annuity, are you getting north of 12%? Most likely not. Is your 401k plan, are you doing north of 9.62%? Probably not. These are the rates of return you have to achieve to compete with an index UL growing at 6.38%. Just to show you that we are truly comparing apples to apples. So if you're contributing money to a cash value life insurance policy, you're actually using after-tax money. And to compare apples to a hypothetical 401k plan, we're actually assuming you're contributing $46,154 pre-tax into a hypothetical qualified plan or 401k plan. Because if you're in a 35% tax bracket and you want to put $30,000 after tax into a life insurance product, you're actually going to have to make $46,154. And what this report shows is you're still going to run out of money when you start pulling out this $110,000 out of your hypothetical 401k plan, because it runs out of money at age 76. And the reason for that, in order to net $110,000 out of your 401k plan or qualified plan, you're going to actually have to pull out $170,000, assuming you're in a 35% combined federal and state tax bracket. Again, one of the advantages of the index UL is the fact that the money grows tax-free. You can pull it out tax-free, and you're guaranteed to never have a negative rate of return. Why can an IUL or index UL policy outperform most other retirement vehicles? Well, basically, the taxes and management fees associated with a typical equity investment more than outweigh the fees, loads, and charges in a properly designed index universal life product. And what a lot of people don't realize is we're actually in a low tax environment. So this chart here shows the history of the top federal tax rate, which started in 1913. Currently, our top federal tax rate is 37%. But the average top tax rate in this country has been north of 57%. So what we're encouraging people to do is pay your taxes now when we're in a low tax environment. Put it into cash value life insurance. You're never going to pay tax on that money again. There are actually only 3 products you can enjoy completely tax-free in this country. You have municipal bonds, where you might get a 2, maybe a 3% yield, which won't even beat inflation. You might have access to a Roth IRA or a Roth 401k plan, but you're limited on how much you can contribute into those types of products. Plus, you're typically investing in equities where you can lose principal, and you have cash value life insurance. That's it. Anything else you put money in for retirement, you're going to pay taxes on at some point in time. This is a good report that kind of shows what the cost of a properly designed index universal life product looks like. So over here on the left, we have a 50-year-old guy that's contributing $100,000 a year for 15 years into a hypothetical equity account. We're assuming this equity account's growing at 7% a year, and we're assuming the money manager's charging a 1.25% management fee. So we're not deducting any taxes from this account. A typical equity account or a managed account is what I would call a back-end loaded retirement account. Initially, your fees are very low. My fees are only about $1,300 in year 1, but as that account grows, as this client continues to put money into it, you'll see those fees start to climb. In this example, this guy reaches age 65 and he wants to start pulling out $148,000 a year out of this equity account. This would be subject to income taxes. We're not illustrating any taxes on this report. This is the amount he can pull out every single year to zero out the account at age 100. So this client ended up pulling out $5.3 million out of his equity account, all subject to tax, and his total management fees over his lifetime, just over $1 million. Now, by contrast, if this client put the same $100,000 a year into an index universal life product, I would call this a front-end loaded retirement account. The fees and charges are high in the early years, but they start to go down. You'll see initially you have a total expense charges of over $17,000 in this index universal life product. But as time goes on, these fees start going down, and our crossover point is actually year 16, where our cumulative management fees on our equity account or managed account is $262,000, but our total fees, mortality costs, and charges on our life insurance by year 16 is $245,000. And we're pulling out $235,000 tax-free out of our index universal life product versus the equity account, $148,000 subject to tax. And at age 100, we pulled out over $8.4 million tax-free versus the equity account at $5.6 million. And our total fees, mortality costs, and charges we spent over our lifetime is only $946,000. So what this chart is basically telling us is the long-term cost of a properly designed index UL is somewhere between 1 and 1.25%. So these are the main parts I wanted to get across on an index universal life product. These are great products that you can set aside money for a supplement retirement plan. We're actually selling a lot of these products to people that don't want or need any death benefit protection. They're simply putting a lot of money into these products because the money grows tax-free. You can pull it out tax-free at any time, and you're guaranteed to never have a negative rate of return. The last element of this product that I would also say is kind of the sizzle of an index universal life product is how you pull money out of them. So with an index UL, there's up to 5 different ways you can pull money out of it. The first one is a withdrawal. That's a tax-free recovery of your cost basis. The money you put in, you can pull it out tax-free. Now, the way we beat the IRS when you pull the gains out of the policy is we call it a loan, and it's a loan you never have to repay back. The first type of loan is called a standard loan. That's the first 10 years of the policy. The insurance company is going to charge you 5% interest, but at the same time, they're going to credit you 4% interest. This is all done internally in the policy. You're not actually stroking a check for loan interest. But the standard loan, you're going to have a negative 1% loan charge eating away some of the cash value in your policy. After year 10, these products have preferred loans where they charge you 5%, but at the same time, they credit you 5%. So you have a zero spread loan, pretty good deal. Well, what's unique to an index universal life product is the option of a participating loan or a variable loan. And these types of loans are available at any time. You could do a participating loan year 1. And so let's say you put a bunch of money into one of these policies and down the road you want to buy a new BMW. BMW is going to cost you $100,000. The dealership's willing to offer you 6% financing. You say, you know what, I think I can do better. So you call the insurance company and you say, I'd like to get a $100,000 participating loan. You get the money, you go buy your BMW. Now, the participating loan charge is 5%. So they're going to charge you 5% on that $100,000 loan, but the credit is going to be whatever you achieved in your index strategy that year. So if you make an 8% return that year, you're making a positive 3% on your BMW. Now think about this for a moment. I was blown away when I first heard about this. You're actually making a positive rate of return on the money you pulled out and spent. As far as I know, there's no other financial instrument out there that allows you to do this. Now, of course, there is a downside to a participating loan. If the market tanks, you're going to have a 5% loan charge on that $100,000 loan in my example, and that does pose a little more risk, but I say risk compared to what? You know, I lost 35% of what was in my 401k plan in 2008. The worst case scenario with a participating loan is you're going to have a negative 5% loan charge on just a percentage of the money you have in your policy. The balance of your cash value when the market tanks, you're going to get a 0 on. What's very attractive is you have the flexibility of moving from a participating loan to a preferred loan. So let's say you have a very large amount of participating loans outstanding and you think the market's going to tank, you can move your entire participating loan balance over to a preferred loan, and you can do that every single year. I'm typically always recommending people go with the participating loan because historically you're going to get an arbitrage. Over the last 20 years, the average participating loan arbitrage has been north of 2.6%, and over the last 13 years, the average loan arbitrage has been north of 3.5%. Insurance illustrations, we are not allowed to illustrate that type of loan arbitrage. You're only allowed to show a 50 basis point loan arbitrage on an index universal life illustration. So many of these IUL illustrations, in my opinion, are conservative. Also, since 1980, the market's up 78% of the time. When it's up, it's typically up double digits. So you're typically going to achieve that loan arbitrage on your index universal life product. That's really what I wanted to go through today. And so if you have any questions or you'd like to get a proposal on an index universal life product, please give BGA Insurance a call. We're in Costa Mesa, California. Phone numbers on the screen as well as our website and our phone number.